Welcome to TheoTrade. This is Don Kaufman. June 30th, 2023. Minutes left inside of this trading week with the S&Ps ripping to the upside. Will the end of the quarter end the rally? Of course, that and much more here on this weekend update. First and foremost, let's mention the obvious. Not just that the marketplace is up today, but we are making again, just blistering move outside the upper edge of the expected move, which it's very easy to say it's a short squeeze. It's this. Look, the bottom line of today's move, there is now statistical significance to it. Not just because we're outside the upper edge of the expected move, which basically implies, look, the market this week was looking for approximately plus or minus a $55 move, right? That was the expected move for the week. Where are we right now? So the week started roughly at about 43.50. We're, almost 100, okay, plus handles outside of that. It's almost, okay, a 2 sigma move. But even more apparent, it's not just the blistering move once again to the upside. And we're going to talk about that because what is driving the momentum today, it's not exactly what you think. It's not just NVIDIA. It's not just Tesla. We'll come to that in just a moment. Okay. What is more significant than the fact that it's a 2 sigma move is you now have 1, 2, technically 3 weeks in a row, that we've actually cracked expected move, which has implications that markets right now are kind of, going through a period of what we term, in here, efficiency to transitioning to like an inefficiency to, in effect, okay, this is where markets are kind of ripping themselves apart. And, when I hop on here, I was like, oh, well, the end of the quarter and the rally. Look, what I'm discussing right now, it's not really about directional bias, okay? It's about a wild ride in a marketplace that the option marketplace is not capable of handicapping the forward risk, okay, at all right now. I mean, it's not even in the ballpark when you're having moves that are, 2 sigma. I mean, for the most part, you're looking at a distribution curve. You're supposed to move up 55 points. You don't move up 55 points. You move up 105 or 110. It's like a 2 sigma move, and you do it, okay, in consecutive weeks, 3 consecutive weeks, okay? And what that followed, all right, was there was a long period where we didn't break expected move at all. Okay, and then all of a sudden, bam, huge rips in the marketplace outside that expected move. And I want that to resonate with you. Now, granted, next week, we technically have holiday trade. So next week kind of breaks down to a 3.5-day trading week, right? Because Monday we're open, but we're only open for technically a half day. It's 3.5 hours of trade in the equity markets. Then we're closed on Tuesday. And then, of course, for the July 4th holiday, we're closed on Tuesday. And then we're open again Wednesday, Thursday, Friday. So it's holiday trade. But one of the things that's already kind of caught my attention is that the expected move for next week is already, $51. Okay. This entire week, this is a 5-day trading week this week. And yet we still had only a $55 expected move. Well, and again, the expected move is not settled. It doesn't settle until about 15 minutes after the close. Still got, 20 some odd minutes left in the trading day. But this stuff's imperative, okay? You got to pay very careful attention because, first of all, what it implies is in a very short duration, short-term options, you want to be a buyer, not a seller. Okay, so if you're talking about like 0-day expiration, everybody in 0-day expiration gets smoked when you're out there trying to sell stuff. Instead of moving, for instance, $55, you move like, $110, you get absolutely smoked in that. So the other thing that it's going to be worth mentioning here on this weekend's update is that we've seen a change of order flow. So let's get down to business, okay, and really start to break down what I see in markets right now, other than the fact, let's state the obvious, okay? Look, the S&Ps are up some 60 handles. The Nasdaq's flying. Okay, almost a 2% move to the upside. And yeah, some boring trade coming into the holiday, kind of weekend over here. But the first thing I want to bring up is what's called window dressing. Okay, is this window dressing or is it a real rally? For those of you that don't know the terminology of window dressing, what that basically means is when it's the end of the quarter, okay, portfolio managers like to quote unquote dress a portfolio. And that basically means like, hey, look, what in the quarter had spectacular returns? Okay, and you look at something like Tesla. This is a year-to-date basis, but obviously Tesla's pretty easy to say. And like, hey, look at the quarter; it was spectacular returns. So they dress the portfolio, make sure that they own X amount of Tesla. When the statements go out at the end of a quarter or halfway through the year, no one cares, necessarily when they bought the Tesla, just that Tesla's in the portfolio. And that's the irony, if you will, of what window dressing happens to be. So the first thing we ask, is it window dressing or is it a real rally? There's no question in my mind that, yeah, this is a real rally. Okay. There is definitely some window dressing going on in the midst of it. And I bring that up because when you start to look at stocks, for example, like a Boeing, it has done nothing really on a year-to-date basis. Year-to-date, it's 8%. It's done nothing. Okay. And it's ironic because it's just not moving necessarily. You can go through, stuff that's worked and stuff that hasn't. Like for instance, Walmart. Walmart's had a good quarter. It's bid today. Okay. Target, horrible quarter. This thing is like a black eye for a portfolio. So what do? They dump it. So when I say to you, like, hey, there's some window dressing going on, it's clear and concise that window dressing is going on. It's transparent in the marketplace. However, I don't think it's in large part responsible for the rally. I think the rally has a lot to do with order flow. Speaking of order flow, one of the things I picked up on this week is order flow in tech. Really, in the last 2 weeks, it's changing. There is definitely a change of pace. First of all, we come to NVIDIA. NVIDIA, smoke and move once again to the upside. Now, hey, look, a $16 move to the upside. It's 4%. Okay. Let's not forget that this thing was getting clobbered earlier in the week. If I bring up auto expected moves, I know a lot of people are talking about NVIDIA. Let me give you a little perspective here, okay, before you get all hopped up. Stock's almost unchanged in the week, okay? And the reality is that tech did not perform extraordinarily well, okay, throughout the course of the week. In fact, I'm going to just jump to it, and then I'll talk about the order flow. The expected moves, I'm showing you NVIDIA right now. NVIDIA is going to finish the week up, just mildly up, right? We can bring up Tesla. It's up on the week. No problem. It's up on the week. All right, here's a wicked move, right? Microsoft, it's right at the upper edge of the expected move. With all due respect, take a look at the SPX. The SPX is way outside the expected move. How is that possible? How is that plausible? Because this week, the energy sector came to life, right? So I'm kind of talking about window dressing, a little bit of order flow and expected moves, all packed into the same thing. Look, this week, what really drove markets, and it's interesting because everybody's like, it's tech, it's tech. It's not tech. I'm showing you it's not tech. Look, energy, 2 times the expected move. Financials, came out with a stress test. Doesn't matter. Almost 2 times the expected moves. Like 2 sigma moves. These products haven't done anything. And on a year-to-date basis, like the financials are down still on the year. All right. The energy sector still down almost 4% on the year. Meanwhile, if you take a look at the QQQ and bring up auto expected moves, it's basically on the upper edge of the expected move. But the S&Ps way outperformed Nasdaq. From an expected move point of view, again, the S&Ps way outperformed Nasdaq throughout the course of this week, and that's one of the things I think that's going to shock a lot of people. They're like, "Huh, I didn't think about that and realize that." Now, window dressing or a real rally, as I said, there's no question. There's a real rally going on because you're not going to convince me that somebody's trying to window dress their portfolio with something like the financials. All right. I mean, the financials really do have a good rip to the upside. There's no question. The energy sector. What's interesting about the energy sector, it had a big rip to the upside. What did oil do this week? Okay. Oil sputtered. Okay. Just sputtering along over there. Continuing on over here. So we looked at expected moves and recognized the QQQ is not necessarily spectacular. With that, in combination with that, order flow in tech has changed. What I mean by that, okay? Of course, I know that CNBC and everybody else is talking about Apple's a $3 trillion company, yay. Look, it's a long time coming, all right? It's a long time coming, but there's nothing to discuss on that front. What there is to discuss, though, is when you start looking at the order flow. When I say start looking at the order flow, lately, okay, we have seen an absolute phenomenal amount, okay, of order flow on the call side, like traded at the ask or above. Today, there is heavy order flow in Apple, and what it looks like is traders kind of rushed the market early in the day, started buying calls in Apple, okay, what eventually becomes the gamma squeeze, okay? And there's no question it's going on. In fact, you can even see it in the sizzle. In the sizzle, we're trading almost 3 times, okay, the normal option order flow versus the previous 5 days. But traded at the ask or above, it's kind of indicative. When the traded at the ask or above is significantly above traded at the bid or below, it's significant to say that, look, they're call buyers in there. They're just going out there and like, buy, buy, buy. And at the open today, that was, again, very, very transparent. But what is interesting, when I say that order flow in tech has changed, okay, you look at something like NVIDIA today. NVIDIA, I've been watching the order flow in here, light and fluffy. It might be up like 15, 16, bucks for 4% move. This isn't call buyers, okay? I looked over at Tesla. Tesla, you think Tesla's sputtering. Tesla's basically at par with where the Nasdaq is. Tesla, there's not this wild order flow anymore in there, okay? I looked over at Microsoft, and again, I watch order flow very, very carefully. Microsoft, okay, yes, the contract size is decent in there, but you would expect contract size to be decent and the sizzle index to be decent. It's almost 2 times the norm. You would expect it to be decent with, almost a 2% move to the upside in the major index product. But the point being, okay, of mentioning this, definitively something has changed. And I'm going to tell you exactly what I see in there. The inverted implied volatility skew, which I've mentioned in several previous nightly videos. The inverted implied volatility skew. What I'm actually referencing is when you look at something like NVIDIA and you go out, let's say, for example, here, to the, just July expiration, a little further out, if that works for you, open up a ton of strikes in here. Okay, the inverted implied volatility skew is actually cause for concern because at some point, instead of professional traders coming out there and buying calls and driving the market to the upside, they look at this and they go, wow, like at the money implied volatility here is 37%. Out of the money implied volatility is like 41%. At some point, proprietary traders look at that, they rush the market and they go, oh yeah, we're not going to buy that, now we're going to sell it. And if they start to sell calls, okay, flips over all the hedging. And one thing that I have noticed, when I say flips over the hedging and selling calls, hey, look, bottom line, let me just get to it. Can flip the market over in a second. So what can actually be a gamma squeeze that's to the upside literally inverts and we start seeing sell side activity because they're selling calls. Selling calls implies that market making firms have to buy calls. If market making firms have to buy calls, they're going to have to actually short stock into it. By the way, market making firms do not have to register and say we're shorting stock. They can short as much stock as they want, because they are construed as bona fide hedgers. Nevertheless, that inverted implied volatility skew, is causing, in my opinion, tremendous two-sided trade. When I talk about two-sided trade over the last 2 weeks, there's one thing that's very apparent. Look at a 30-day 1 hour with me. Just zoom into it for a second. 30-day 1 hour. And all I want to show you in here, when I'm talking about two-sided trade, we're seeing all kinds of like intraday. We rallied, we sold off. We rallied, we sold off. Intraday reversals. Granted, we finished the week higher. I got it. We finished the week higher. Okay. But we're seeing two-sided trade. And I got to tell you, I like it. I like it. That, okay, for a trader like me, that's what dreams are made of right there. Critically important. All right, moving on. Bonds and yield curve. One thing I am absolutely surprised about yesterday, for example, the bonds reached deep into like the 126 handle. That didn't panic the Nasdaq at all. I mean, yeah, it reversed at some point, but we really got to be mindful of bonds now, because what a lot of people are missing, if you take a look now at TNX is the 10-year interest rate, okay? In my opinion, this is just my opinion, going from 3.4% on a 10-year and screaming, okay? And again, it's been range bound, but now we're screaming all the way to 3.8%. At some point in time, that cannot be good for markets, right? I mean, look, you don't know where it is. Is it 3.9%? It's 4%. If the bonds continue to sell off, granted today they're up, but if the bonds continue to sell off, okay, I feel like the Nasdaq is completely ignoring it. And the Nasdaq is ignoring fundamentals and it's ignoring technicals, which is fine. But rates are something completely different. When you start looking at the yield curve, for those of you that don't speak geek, okay, here we are actually over on Tasty. And in Tasty, you can see the 2-year. Like the 2-year is at 4.86. That's the 2-year, 4.86%. Meanwhile, the 10, okay, is at like 3.8. What's 100 basis points? I mean, the inversion of the yield curve is phenomenally large and ironically continues to grow. And again, what point, like, when the market itself, like if that's not screaming recession, that's not screaming recession. I mean, maybe you should take a look over at stuff like, ZC, which is corn. By the way, there's a contract roll in here, but it doesn't matter if there's a contract roll. It's just getting annihilated. Okay. Corn it's on fire. I mean, I looked at wheat as well. Okay. Like ZW in here. It is a chaotic marketplace. So I'm definitely bothered by it, because between yield curve, some of the commodity products actually backing off, it's just like the market just keeps chugging. It just keeps chugging. And again, that's why I bring up, well, the end of the quarter, end this rally. I don't think it's necessarily the end of the quarter. I don't think it's window dressing. Okay. But you're in a dangerous position right now with markets, gasping almost to the upside. I'm ever the bear. I'm ever the bear. And I continue to be bearish of this marketplace. Okay. When I look at upside potential versus downside risk, okay, the downside risk continues to really resonate with me. All right. Quick position update. In terms of positioning this week, all I really did was covered, and was ironic. I was able to actually buy back puts for a 50% gain. I bought back my 35.50 puts, okay, for $9. Originally sold them for $18.25. Okay, I also bought back calls for a 50% gain. And again, so if you're interested in the original transaction, I can go back like 40, 50 days in here. Anyway, there's the 3,900 puts. I originally sold them for $9.25, bought those back for $4.60. If you look at this, 35.50s, those 35.50s, okay, the 35.50 puts, okay, I went out there and originated that trade right here for $18.25. So both of those within 3 weeks. Okay, again, you see the marketplace rallying. Well, we bought back puts, but we were also able to buy back calls profitably, even in the face of a market rally. And that's one of the things I love to update positions. All right, last but definitely not least, of course, the expected move. In terms of expected move, well, we already discussed the fact that we are way outside. Okay, way outside the upper edge of the expected move. That's going to be a highlighted candle for the ages because it's almost a 2 deviation move. Nevertheless, as I said, I think we're entering from a period of incredible efficiency, okay, and shifting very rapidly to inefficiency. And when we've seen this in the past, okay, multiple, weeks of cracking through expected move, okay, it has often been met with volatility overall hitting the markets once again. If you look back at 2022, I know a lot of you try to forget what happened in 2022, but you will see, okay, it didn't matter whether it was to the upside, to the downside, to the downside, to the upside, okay, but volatility just reigns upon the marketplace when we start seeing, okay, weeks, and it doesn't even have to necessarily be consecutive weeks, but look, okay, in 2022, which is a period of extreme volatility, okay, how many weeks in a row that we started cracking through. And interestingly, ironically, we had several up weeks where we actually smashed through the upper edge of the expected move before coming through the downside of the expected move. It does not matter. These little, again, boxes in here are just representative of not touching outside the expected move, but closing outside the expected move in any given week. What you will notice, though, more than anything, okay, is once we start getting multiple or consecutive breaches of expected move, at that point, it's on and volatility is there. Thanks everybody for joining us here at TheoTrade. Have a wonderful holiday weekend. Again, markets are open on Monday for a half a trading session. We will be here broadcasting on Monday. Markets are closed on Tuesday. Remainder of the week, we are open. Have a great holiday weekend. Bye-bye.